Hello and welcome. My name is Doug Omont. I am a certified financial planner and also a licensed insurance agent. I am the founder and president of both Financial Thinking Partner Wealth Advisors and the Annuity Strategy Center. My whole practice is grounded in the belief that defense wins championships. When you go from saving to retirement, where you're going to start living on your assets, the whole philosophy and mindset changes. In today's presentation, we're going to talk about how retirement changes the game. How once your goal was growth, now your goals shift and they move to three things, namely income, protection, and peace of mind. All right, so let's discuss that shift that happens at retirement. During your savings years, a market drop actually worked in your favor. And why is that? Traditionally, for most folks, when you're working and are receiving a paycheck, every 2 weeks, you're contributing a piece of your earnings to your retirement account. And so when we have market pullbacks, you're not changing your contribution. So you're actually able to be buying more shares at the same fixed contribution amount that you were doing. And so that's where market pullbacks actually can be a benefit to you while you're saving. That completely changes when you're in retirement. Because when you're in retirement and you no longer have that salary, that income coming in, you're now turning to your assets. So this could be your 401k, this could be your IRA, this could be whatever retirement accounts that you've set aside that you now have to take distributions from to support your lifestyle. And so the opposite is true here. When a market pullback happens, you're now forced to sell more shares to get that same dollar amount. So now a market pullback is in effect locking in those losses, leaving less shares available to ride an eventual recovery if and when the stock market does recover. And so that is one of the fundamental changes and why your investment mindset and philosophy needs to shift. And what worked for you during savings and accumulation won't work the same when you're in retirement and decumulation. And so we talk about it. You have the same portfolio, but now the rules are different. All right, so what are those risks that you have to be planning for? Well, let's go through them in order. So one is sequence of returns. This speaks to the idea that the 5 years before and after your retirement date are what we call the retirement red zone. It's a fragile period where a sequence of bad returns can have an outsized negative impact on your overall plan. And so the sequence is more so the order that these returns show up rather than an average. When you were saving, we always focused and anchored a lot of our discussions around averages, right? We see an average rate of return of 7% or an average rate of return of 10% or whatever it is. But the averages don't matter as much in retirement when you're taking distributions. Like we talked about, a down year and you're taking a distribution has a compounding negative impact on your portfolio. And so we need to structure your portfolio in a way to protect yourself from this risk. The next one is longevity. This is the idea that with health advances, lifespans are increasing much longer than they had generations ago. And so now a 30-year retirement is becoming more and more normal. And so your income has to last for a very long time. And for most of us, we don't know how long we're going to live. So it's an uncertain planning exercise that we have to go with is we don't know how long we're going to live, but we know we don't want our income running out while we're still alive. So that is one of the risks that we need to make sure we have a plan for. Next is inflation. As we know, prices tend to roughly double over retirement. And that's because inflation happens gradually, but in sometimes we might even get it to spike like we saw recently during the COVID-19 pandemic when we saw a shot in a lot of different prices, both in the nominal price that you see, but also through shrinkflation, right? Where, the bag of potato chips, for example, that used to be full is now less full, but you're still paying that same dollar amount. Well, this just speaks to the idea that your dollar is not going to stretch as far 20 and 30 years down the road that it does today. Health and long-term care. In a perfect world, we'd all gracefully exit this world. But for most of us, we're going to have some sort of healthcare event. Hopefully, it's not something chronic, but we don't know what's in store. And so we need to make sure we have a plan in place to cover any unexpected health expenses to make sure that we maintain a level of independence and autonomy throughout our lives. This way we don't become a burden to our children, to our family, to our friends, to whoever, and we don't want to be left without choices on where do we receive this care and what level of care do we have access to. And then always, as we know, life is great at showing us all these what ifs, right? We know things are going to happen along the way that are unexpected, unplanned for. We just don't know when they're going to happen, and we don't know how costly they're going to be when they show up. So we need to make sure we have a plan to set aside for these emergencies, helping family, these unexpected events that are going to happen. All right, in front of you here, this is a chart of the big pullbacks that have taken place in the S&P 500 going back all the way until 1961. And so you can see here, market pullbacks are not rare. In fact, they're quite common. On average, a bear market, which is just another name for like a recession, or when we've had a pullback in the stock market, happens every 5 years or so. The average decline is a little over 33%, and the average duration of these declines is about a full year. And so these are the types of things and strategies that we need to plan for. We don't want to let our income be subject to what's happening in the stock market. Could you think back to when you were working? Could you imagine that your boss came to you and told you, hey, we're actually going to cut your pay this month because our stock price is down, right? You would be outraged. You would be outraged and you would not want to continue working there. So don't let the volatility, the movements both up and down of the stock market impact your paycheck in retirement. We want to make sure we have a plan set aside that doesn't hinge upon the stock market performing perfectly throughout that possibly 20 or 30-year retirement for you. All right, so let's talk about math, right? None of us like math, but it's important to get a concept down. And this talks about how much of a recovery we would need to just get back to even from a pullback. And so you can see a 50% pullback in the market will actually require 100% recovery. And so it just goes to show you, the larger the pullback, the larger the recovery needs to be. Right? So you lose half your account and it's going to take it going a full 100% just to get back to where you started. This isn't even talking about growth. And so this is where defense matters, especially in retirement, when you're relying on these assets to cover your income and your lifestyle. We need to play defense. We need to protect what you've saved, be good stewards. And we also need to figure out a reliable way to efficiently take these assets and convert a portion of them into an income stream that you can't outlive. All right, so the sequence of returns, why this matters more when you're drawing income, right? So this is what we've been talking about. So in step one, right, the market drops, a downturn arrives. And as we showed, every 5 years or so, they're going to be appearing. So they arrive regularly. But you still need income. Even though the market's down, your bills don't pause. So you have to sell shares to cover those expenses. Now your losses are getting locked in, right? You had to sell more shares while they were down, leaving fewer shares left in your account to ride what we hope will be an eventual recovery in the market. And so this is where a few, weak years, especially at the beginning of your retirement, can have a really big impact in your ability to draw income and to protect your legacy and lifestyle in retirement. All right, so how does playing defense stack up? Right, so here's a chart that shows you a visual representation, and that bottom line, that gray line with those gray dots, this is showing the period of time from 2000 all the way through 2025. And we're looking at the price return of the S&P 500. The green line, which is above it, is showing what it would look like had you had that same $100,000 invested in a fixed indexed annuity that had a 0% floor. So what that means is every time the market had one of those pullbacks, which remember happen every 5 years or so, every time the market pulls back, you don't lose any money due to market losses. So your account stays even when the stock market is down. Now, the trade-off, because everything we talk about has a trade-off. So with a fixed index annuity, the trade-off is when the markets do perform and there are gains and growth, you're not going to get all of them. You're going to get a portion of them. And so in this illustration, I'm showing you what's called a 10% cap. What that means is if the markets are up 20%, for example, in a given year, from January to January or from June to June, a 12-month period, you're going to get 10%. That's the cap or the maximum rate of interest that you can earn during that period of time. And so this is just showing by eliminating those losses and not even getting a full amount of the upside, we can still come out ahead by skipping the worst years and capturing a piece of every gain. We can actually outperform the S&P 500. Now, granted, this is excluding dividends because when you're in a fixed indexed annuity, you're not actually invested in the stock market directly. You are receiving interest that is credited to your account based upon the performance of an index. So that's a key distinction to keep in mind. This is just showing you the price return of the S&P 500 excluding dividends, and it's showing you what the fixed indexed annuity would do, again, excluding dividends. So let's not get too hung up on the dollars that we're showing here, whether it's 464,000 or 483,000. The concept that I wanted to share and what I wanted to teach upon is that by playing defense, by removing those worst down years and getting a piece of the upside, we can keep up with the S&P 500 over time. All right, so my framework, which I want to teach you now, is to give every dollar a job. And so you start with a statement value, right? These are your assets. You look at your 401k, you look at your IRA, you see a statement balance, let's call it $1 million. That's your assets. From that, we need to now allocate different dollars to different jobs. So the first thing we need to do is we need to create income, right? You no longer working, and Social Security for a majority of people is not going to cover your living expenses. So we need to create a reliable way for you to receive a paycheck for life. So the first job that we want to assign is taking a portion of your assets and then putting in place a secure, guaranteed lifetime income stream that will then complement your Social Security payments. And if you're fortunate to have worked at an employer that also offers a company pension, then you can also layer that on as what we call your income floor, where you have your, at a minimum, your bare essentials, your needed living expenses covered by guaranteed income. But for a lot of folks that I work with, they don't want just their bare essentials covered. They also want their discretionary spending, because that way they don't have to question, well, should I take the trip? Should I donate to the school, or should I donate to my church? Because they know without worry, they have a certain dollar amount coming into their bank account each and every month in retirement. All right, the next job. We need to make sure we have a plan for these what ifs, right? We need a plan for emergencies, and we need discretionary access to funds. We need liquidity. So we need to keep some money available that's not going to be tied up in a product that has prepayment penalties or exit fees or things like that. And so we need to keep in mind that some of our dollars are going to be for income. Some of our dollars are going to be for emergencies and liquidity, because we know life's going to happen. And then that last job, we need to, for a lot of folks, want to prioritize making sure you leave a legacy. The whole idea is hoping to leave your children and grandchildren a little bit better than you started. And so this is where we can possibly assign a piece of your assets to get passed on for legacy and in the form of a death benefit. All right, guaranteed income. So you need income to support a lifestyle. Ideally, you're setting up an income stream that you don't have to be worried about outliving. And so what are your options? Well, your first option is to draw it from your investment portfolio, but we talked about that already. If the accounts are down, are you going to just not need as much and you're okay taking less? Or are you going to have to sell more shares to get that same dollar amount to cover your bills? But then in doing so, you're really depleting your assets, meaning they may not last as long as you do. Or what I like to do with our clients is we take a piece of your portfolio that we have assigned for the job of guaranteed income. We put in place an income stream that you can't outlive. That income stream can be designed in many different ways. If you're married, it could be designed to last for both of your lives, both you and your spouse. If you're single, it can cover your life for a fixed number of years, or it can cover your entire life regardless of how long you live. There's many different ways that we can structure and build that income stream that aligns specifically with whatever unique goals and objectives that you have for you and your money. All right, so these are some key questions to be asking yourself as you work through this, because this will help to identify some blind spots, right? First one, how long are you going to live? For most of us, it's a head scratcher. I have no idea how long I'm going to live. I'm going to look at maybe my parents to see how long they lived, my grandparents to see how long they lived, because that might give me a general sense for kind of how long people tend to live in our family. But I know that my life and my lifestyle is different than my parents and my grandparents. And so that may not be a true indicator of how long I'm going to live. And so the same is true for you. So kind of think through that. How long are you going to live? And then this one. No one has a crystal ball. Not your advisor, not your broker, not your nephew, not your son-in-law who day trades on Robinhood. No one. When we ask, what is the stock market going to do tomorrow? Is it going to be up? Is it going to be down? Is it going to be flat? We don't know how to answer that question. And we definitely don't know how to answer that question over the next 5 years or even next 10 years. And so with that stock market account, what are you willing to lose? Are you willing to lose all of it, none of it, some of it? And then what's most important? Are we putting in place a plan for living where we want to spend the money that we've so diligently saved? Because a lot of folks that I work with, you are very good savers. You have built that into your, personality. That's something that you've now ingrained in your DNA. But one of the challenges with becoming a really good saver is it becomes even more difficult to then spend that money that you've so diligently saved. And so we need to really address the idea of, are we putting a plan for living where I want to spend it while I'm alive? Or are you more concerned with a plan for dying, where you want to make sure that you leave a legacy? You're okay not spending that money now. We just want it to grow. We want to be good stewards and protect what we have so that we can pass that along to the next generation. And then, do you have longevity insurance? Now, a question I often get is, well, what is longevity insurance? And it's simply this. Do you have an income stream that's not going to run out before you do? Said another way, do you have guaranteed lifetime income that will continue coming in regardless of if you live 20 years, 30 years, 35 years into the future? And then what insurance is protecting your accounts from market downturns? We talked about that in an earlier slide, how often the S&P 500, which is really just a great proxy for the overall stock market, it has big drawdowns every 5 years or so, and those drawdowns can last almost a year. And so what insurance protection do you have in place to help protect you from those market downturns? And then lastly, a solid plan is not solid until you have peace of mind. And you get peace of mind from making sure you're covering all of those possible what ifs. So what if I run out of money? What if the stock market loses value? What if I pass away? What happens to my money then? What if I have medical expenses such as long-term care and Medicare is not going to cover that? What's going to happen to me then? And what if I live a long time and inflation gets really bad and it hurts my income? How am I going to make sure I have resources available to make sure I can continue to living my life and not have to shrink my lifestyle because my resources no longer support my desires, my needs, my wants? So let's put it all together. The idea with our process is we want to put a plan that you can live on and live with, right? It needs to both support your needs and your wants. And so we need to have a plan in place to cover those real risks, right? The sequence of returns, longevity, inflation, healthcare, and all those what ifs. We also need a plan to protect the fragile years, right? We don't want to let a bad market early in retirement dictate what we have now available to us later in retirement. We never want to become a burden to our family. And we do so by giving every dollar a job, right? We need to maintain access, income, and growth. because a portion of your money needs to be available for those lump sum expenses. That could be the car repair, the home repair, even if it means more something like fun, like you have the opportunity to go on a cruise and you need to put down a deposit. We need to make sure you have access to liquidity to take advantage of those opportunities. We also need a reliable income stream to come in that will come in each and every month, regardless of what's happening in the stock market, in the economy around us, and regardless of how long you live. And then lastly, we need a piece of our portfolio to still have focus on growth. Because as I talked about, inflation is that silent killer that can erode your purchasing power. $1 today will not go as far as $1 a decade or 2 decades or 3 decades in the future. So we need a portion of our assets to keep growing so that we maintain the lifestyle even as things are getting more and more expensive. So the idea is now your overall portfolio is allocated into different jobs with each part doing its job. All right, I appreciate you making it all the way to the end here. Again, my name is Doug Omont. I am a licensed insurance agent and also a certified financial planner. I've been in the wealth management industry now for over a decade, working with families of all different sizes, all different backgrounds. And one thing remains true. When you go from working years to retirement, it is a complete mental mindset shift that I will help prepare you for by putting a solid plan in place, one that first is designed around you. So in our process, step one is all about learning what's important to you. What are your objectives? What are your goals? What are your priorities? What are your concerns? What are the risks that you see that are really going to impact your future? I want to get really clear on all of that because that's going to serve as our North Star that then we'll look at and do a deep dive into your overall assets. We'll look at both your investment assets and whatever other assets you may have, whether it's real estate, commodities, whatever you have. And then also look at your income streams. Where are your income streams in retirement going to be coming from? Once we get a full picture of both your objectives, goals, priorities, and then also what assets and resources you have, I will then offer recommendations based upon what you've shared with me. I will show you how we can put a plan in place to both protect your future and protect your desired lifestyle. I look forward to meeting each of you in person, and until next time.